Hello and welcome to Commodity Champions. I'm Manisha Gupta. Crude prices are at a 7-year highs after simmering geopolitical tensions between Russia and Ukraine have kept the market on the edge. Being the world's second largest supplier, a potential Russian invasion could draw sanctions on the Western world, which in turn would stiffen the global supplies. Despite the wild swing in prices, however, experts say that there are bullish indicators that the underlying market remains robust. This makes the geopolitical happenings of this week all the more crucial, with many fearing that crude will touch $100 a barrel. So what is the outlook for the energy sector, and will anything stop crude's meteoric rise? Joining me now to take the discussion forward are Paul Hicken, Director at S&P Global Platts. Sushant Gupta is Director at Wood Mackenzie. We're also joined by energy economist Roberto Aguilera. Thank you, gentlemen, so much for joining us. And crude, as we say, is geopolitics and politics and then some fundamentals. This one is to you, Roberto. How much would you say that the Russia-Ukraine premium is in the prices? Are there any chances of a war at all? And what is the probability of a supply disruption even as the tensions continue to be on?
Well, in my view, many of the analysts are getting a bit carried away with their price expectations for the future, mostly because they are worried about the potential for conflict between Russia and the Ukraine and what that would do, how it would disrupt crude oil production. But in my view, that scenario is unlikely. And even if there were to be conflict, it doesn't necessarily mean a disruption of oil and gas supply. So I believe that there will be huge amounts of new production actually coming on stream this year that will eventually result in an oversupplied market and put some downward pressure on prices.
All right, that point is well taken. Sushant, would you agree to that a war situation is unlikely? And even if that happens, even if the tensions escalate, the supply issues or supply disruptions is something that the markets perhaps will not see?
Well, I think, so there are two scenarios here, right? If there is an escalation of the conflict between Russia and Ukraine, we could potentially see risk to the supply from Russia, the world's second largest producer of oil. Now, the extent of disruption, as pointed out earlier, depends upon the extent of the Western sanctions against Russia, and also on the export infrastructure from Russia to other parts of the world. Now, we expect the more impact on oil exports towards the West rather than the East. So, it will take time for Russia to arrange alternative oil export routes and also for OPEC to dip into spare capacity. So, yes, there is spare capacity available within OPEC, which can be used, but it takes about 3 to 4 weeks to dip into and bring that production in the market in case of any supply disruption.
You mentioned OPEC, and Paul, I'll take it to you then. And even as OPEC has been increasing production every single month for last 8 or 10 months now, they haven't been able to keep up to their quota. December was lower, January is even further lower. What's your sense that you get from OPEC and allies, and how much of that premium do you see in prices?
Yeah, this is the thing with OPEC Plus, is that there's a two-speed OPEC right now, which is one that can meet its quotas and one that isn't being able to do so. The core ones being Saudi Arabia and UAE being the big ones who are pumping strongly. But the problem is, when you don't have them meeting that 400,000 barrels a day increase each time, is that they're not meeting that. Let's wind it back to fundamentals. And it's not meeting that strong demand growth that we're seeing across the board. Gasoline and diesel cracks are very high. Transport is really coming back strong on the road, for roads at least. And so we've got strong fundamentals in terms of demand. And with the geopolitical risk and thinner spare capacity, as OPEC Plus continues to pump more, we're exposing the market to a less spare capacity. It's falling every month, and with depleted stocks, we're in a position where the market is very nervous about what could happen. We saw it before, not with Russia, but with Libya, when we had the Libya outage and the market got very volatile earlier this year. So it's that geopolitical premium and that thinner spare capacity, which is creating that volatility. And we're seeing that even when supply comes back, is that we can have even lower spare capacity.
Well, that's about the supplies really, and there are concerns coming in from all sides. But Roberto, what numbers are you putting out when we look at 2022 in sense of demand and supply? What kind of a gap or a mismatch are you looking at?
Yeah, well, in my view, it'll just be a few months before the supply side exceeds the demand side. And so already in the second quarter, I could imagine prices coming down into the 70s and then the situation persisting through the rest of the year. But even more of an oversupplied market in the second half of 2022 and even 2023, which would bring prices down as low as the $60 a barrel level.
Well, yes, that is a view that really seems to be coming in across board. And Sushant, how would you look at that? Because this year is as uncertain as it gets. There is a Fed rate hike coming in. There is COVID uncertainty still into the markets, a lot of pent-up demand. But would you say, and what range would you really put crude prices to begin with?
Well, a very interesting market as you described. Now, I think I would mention that, yes, I would agree with the overall view that going forward, we do not see a shortage in the physical market as we are seeing today. Yes, today the markets looks tight given the low crude and product inventories. But as we go through 2022, we expect stocks to continue build because the global oil supply we are forecasting is higher than the global oil demand growth for this year.
Okay.
But at the same time, we also have OPEC spare capacity, which can be used in case of a tight market. So overall, we expect, quarter one, quarter two, current inventories to build, and our prices we are forecasting for quarter one around $90 per barrel, and for quarter two around $85 per barrel for Brent. Now, we do expect the current geopolitical risk premium to reduce over time as the fundamental starts to exert more pressure on the prices or influence on the prices.
So, Sushant, what you're saying is that these geopolitics that we are dealing with right now of Russia and Ukraine are not very long-lasting, and we might get over with them this week, this month, this quarter?
Well, I mean, that's the nature of, these geopolitical events, right? It's very difficult to forecast, how long will they last. But what I'm saying is, assuming, these events are not there and the influence of those events are removed, then from a fundamental perspective, oil market is looking oversupplied for this year. And I think, if you look at what OPEC has done in early Feb meeting, they have not increased their supply, for March. So they are very closely following the market as well, and every month they would make changes to their production forecast or production for the month. If there is a tightness in the market. So, overall, we do not see the markets to remain tight if we do not assume further escalation of the current crisis.
Point taken. While there is a lot of